scaling. Premature scaling, there are internal and external factors of a startup. Internal, for example, are employees or is the financing. External are customers and stakeholders. And so that a startup doesn't fail, it needs to have a balance. What we actually see in the ecosystem is that a lot of startups reduce, for example, their employees because we had a huge amount of funding and also a huge amount of employees that grow from that fact. So that are a few things that I hope will be mentioned in the next panel and also give you a feeling why the next panel is so important. For the next panel, I want to introduce Elena as our moderator. So Elena Chloba from Wolf Summit. A hearty welcome to her. And why did I mention the huge amount of investments? Because now on our stage, we have several investors and VCs that invest a lot in startups, and they are very familiar with the numbers I mentioned. So please welcome on stage Nico from High Ventures. Welcome. Andreas Nemeth from Unica Ventures. He's also based at VAccelerate with this company. Welcome. And Johannes Blaschke from Calmstone Ventures. He's principal there. So, welcome, Johannes. Yeah, I give the mic to Elena, and I'm very curious about the insights.
Yes, thank you so much for the introduction. It was really cool. We had a round of applause for everyone. So I wanted to start with intros because I think the audience is curious about what is your expertise in investing in startups. Maybe we can start with Aniko.
Yes, so hello, I'm from High Ventures, which is a Hungarian state-owned and EU-funded VC. We started our mission 5 years ago, and we investing in super early stage with just 50K, and we have 3 different phases where we invest in with 3 different teams with different mindsets, as you will see from the panel, until the growth phase, which is kind of a 1-3 million euro funding. We already have more than 400 startups we invested in.
That's impressive. Thank you. Maybe Andres, we can, hop.
Okay, thanks. Thank you very much for inviting me. Thanks for having me. So I'm from Unica Ventures. Actually, we are based here not only in Vienna, but actually here at VAccelerate on the first floor. We are a 150 million fund. Investing at the early growth stage. We've built a portfolio of 49 companies so far, investing all over Europe, but actually we have quite a natural bias towards Central and Eastern European countries, and invest in the verticals like fintech, insurtech, but also digital health is one of our major focus areas, as well as mobility, and quite recently, we've also started in investing in clean tech.
Yeah, thank you so much. And Johannes, say something about your expertise in investing, because each of our panelists here have different expertise, but they all have really great amount of knowledge to share.
Sure. Hey everyone, Johannes here. Maybe a quick intro on Calm Storm. Basically, we were founded by Lucanos Polagnoli, who was one of the first general partners of Speed Invest. There, he also was CFO at some point, and even before COVID, had the idea of building this European healthcare fund. And then, of course, COVID hit, the space boomed. By now, the pace has been incredible. 55 investments, most of them in UK, in America, and spread across the rest of Europe as well. The spaces we invest in, all digital health, less on the life science side, less on hardware, but really digital health solutions, particularly in aspects we call taboo. So femtech, sex tech, mental health, quite often also let's say, diseases that have a stigma around them, such as constipation. And these are kind of the startups that we particularly look into. And the ticket sizes we do are usually at 150K to 300K, so super early stage. Me, for my background in consulting, worked at BCG a few years, based from Zurich, consulted big pharma and medtech companies, and previously worked at Speed Invest, back then still in the fintech team, where I got to know Lucanos. And then I also worked in the UK at Oxford Sciences Innovation, which is a fund that really invests in spin-outs, so quite at the interface of academia and entrepreneurship, where you would really invest in professors, PhDs, and rather in their research projects than already in established companies.
Okay, great. Thank you. We had a round of intros. We know who everyone is and the expertise. And the first question is about basically how do you make your investment decisions and what drives the investment from your expertise? Because the topic of this panel is the differences between investing in early and later stages. Basically, there are differences between investing in early and then closer to IPO. So regarding this, how do you make your investment decisions when investing in startups and what drives your investments? Maybe Eniko, you can share something.
Yeah, so of course it's really different at the different stages what we are investing in.
Sure.
I think in the super early stage we kind of like a mission to support the young talents, even university students, to follow their dreams. So if they have a good idea and a good concept, of course, what they can reach from the super early stage investment, and we see the next step and we see the high potential in it, we would definitely invest in it. So, but the most important things I think in all stages is the team. Whether the team is capable and seems perfect for their plan, whether they can reach the next step. So I think it's really important that if they bring a good product or a good idea, but you don't see the perspectives or don't see where they want to go, or even you see that they want to make a small innovative SME, it's not a good match for us. But yes, there's kind of a mission in early stage, but later on we would only invest just to the best ones from the super early stage, and in the next level we are much more critical in some criterias, but I think we will discuss it later.
Yeah, what do you have? Is this the same for you? Andreas, Johannes?
Yeah, I think that really resonates, particularly the founders part, because for us, at super early stage, that's really the one most important thing. And the way I would see it, let's say across the continuum of startup evolvement, would be a little bit that at the beginning, particularly for us as super early stage investors, it's more about the founder market fit, then product market fit, and later on probably more on financials, metrics, KPIs. And let me maybe give you some color around that. So for us at the beginning, of course it's important to check the product, but the product often changes, honestly. The market, that's important. Like, we want founders that have a view on the market, think about it the right way. But the founder market fit is everything, because the founder usually it doesn't change, while the product can. And this is also a little bit where we at least have a dilemma inherently, because how do you estimate whether the founder is the right founder to scale a company to a unicorn? It's almost impossible, because you can't predict, let's say, a person's or a child's characteristics while it's still in the womb, while it hasn't seen the light of this world. And this is really hard for us. And what I think a lot of investors do, they feel like, okay, the founder right now, one can't see him or her scaling it super highly or quickly, but it's really about the scalability of the founder and whether the founder can also attract the right people, because the founder honestly wouldn't do it him or herself.
What's your point of view?
So I think it has been mentioned that it's all about people. That definitely is true. And for us, investing at a bit later stage, it's definitely, I would not say it's not only the founder, but it's more the organization that we are actually looking in. How coherent the team is, do we see already a good combination, a strong supporting team of people that already have organized in a way that is ready for growth and for scaling the company later on. We usually see let's say at a stage of development where they have a 30 to 40 people team, that this is changing a lot. So I think from the initial exploration phase, where it's all about finding your product market fit, iterating, changing your business model over and over till you really have established product market fit. I think the next stage definitely is then once you have found your market, to really prepare for growth and organize accordingly. So I think that's definitely still a people soft factor. But I think we will also touch on the KPIs and on the traction that we want to see already at that stage, because I think it's not only about the founder fit, but it's then already about market fit and early traction.
Yeah, that's, everything is about people, it turns out, even in tech world and startups and investing where metrics are everything, but people as well. But we already heard that on different stages, for an early stage, it's important to see how the founder fits into the market. On the later stages, it's more about the growth. But what are other differences that you noticed when investing in early startups and versus IPO? Because I think, Eniko, you have experience in both, yeah? You can share something?
We have experiences only in exits. So the fund established 5 years ago. So we feel that it's okay that we are not reaching the IPO with the companies because it's in the early stage. But of course, we see differently, and we know that the next round investors or even the buyers have a different perspective when they look for the early stage or in the growth stage at the companies. Of course, at the early stage, there is no traction, what you can look for. But maybe you can tell more about it, Johannes. How do you evaluate this part? But at least you have to show some market fit or something about your product or your plans. And I can say that it's much easier in the growth phase because you have some metrics, but it's really far from what you see when you evaluate a company who has 10 years historic data, and you can just evaluate their plans from the historic information. So, of course, we need some KPIs. Even they are ready for scaling up. Do they have a business model which is a fit for the product and also for the high potential? So there are, I think, really wide range of KPIs, even depending on the sector they are in, because we cannot say just yes, this revenue metric is good for all the tech startups. No, I think it's really different.
Yeah, absolutely. Maybe from our perspective, let me give you an example of how I look at startups. For example, at the moment, we're talking every single one of us to 5 to 10 founders per day. And when I'm in a founders call, of course, beforehand, you take a look at the pitch deck, try to have a view on the market, ideally. Make sure there are no competitive investments. Have you done investments in the space? Try to learn from that. And then you would write down the few categories, which for us usually are team, as discussed, super important, market, product, business model, and then something like deal structure. How does the cap table look like? Who else is involved? What's the timeline, etc. And of course, you have to put some check marks around everything because all of those are important. For us, given that we're so early, it's more feeling than later. I think later on you would can really put KPIs around it. But for us, I think it's more a feeling, and I think for us being a mission-driven investor, what we want to really see in founders is that they have this vision of creating a better reality, because we truly believe that founders are able to create new realities. I think we've seen it with people like Musk, Zuckerberg, Gates, Bezos, and I think these days, and this is a little bit our plan, if we channel these kind of people to the right social questions of environmental challenges, health challenges, social challenges, then we can have a big impact. And this is also what we want to see in the founders. But yeah, what's your take, Andy?
May I build actually on what Johannes said? And for Unica Ventures, and I think maybe let me also use that opportunity to once again stress that although we have a very powerful brand and are backed by one of the largest financial sponsors in Central and Eastern Europe, we are, and I want to repeat that as many times as possible, we are not a strategic investor. So when we are going about startups, we are not looking for any strategic benefit for the Unica group, but we are actually a purely financial return-driven investor, as all the other VCs are. With a single LP that is providing the capital. So we are not looking for strategic fit, but we really look for founder fit. So building on what Johannes said, it's also very key, the team and the people. And if we really want to work with them for the next 10 years to scale and take them to IPO or exit. So it's still the team, but what we actually add on top of that are actually 5 KPIs that we are looking at. What we want to see is definitely some maturity in the business in terms of revenue. So 1-2 million revenues or in excess of that annual recurring revenues. What we also want to see is the growth trajectory. So I think we are an early growth stage investor. For us, 200% year-over-year growth is the absolute minimum. And on top of that, we also look at the margins and the profitability of the business. Might differ from different business models or sectors, but these financial KPIs are definitely what we are first and foremost looking at. But also about the efficiency. And I think that has a bit changed also over the past couple of months. Before that, growth was enough. Nowadays, I think it's more the sustainable and efficient growth. So that's why also the combination or the relationship between how much money has been spent to achieve that growth is definitely becoming much more important nowadays. And is that a business that is really self-propelling? Is that do you retain the revenues and do more business with existing customers? Is also one of the KPIs we look at, because at Unica Ventures we are definitely more a B2B focused investor, less with B2C models. But I think it's either how much revenue you make with existing customers, and if you can scale that. In the B2C space, it's more the customer acquisition costs that count.
We touched upon the topic of the macroeconomic situation, that now it's not the same as it was before. And also, I want to ask you, maybe this way, this time we'll start from Johannes. How's the macroeconomic situation influences the valuations and how, like, the investments? What's the way? Have you changed anything? Do you want to share anything about the changes?
Yeah, sure thing. So let's take a step back and look at the last few years. What have we seen there? Craziness. A lot. A lot of investments. Nobody took a look at the valuations, really. Nobody scrutinized the business model, but it was all about hyper growth, hyper funding. And these days, even for us, we tend to look a bit more at things like, hey, when can you become profitable? When can you become cash flow positive? Does the business model already work? So these kind of things are already becoming more important now. For us, valuations, not so much, because honestly, it's not random, but almost random at the beginning, right? You can't we sometimes invest pre-top line, we sometimes invest pre-product readiness, so we usually don't argue about the valuations, maybe more for you guys at later stages. And macroeconomically, maybe one more point on our investors. Of course, as a fund, we are dependent on our LPs, on our limited partners that invest in our funds. And if you look at the macroeconomic situation with stagflation and everything that's going on, what's happening when the capital markets are going down, all of a sudden they're going to be overexposed in the risk capital, and particularly in VC funds, obviously. And then for us, it's less of a problem, given that we are a smaller fund, almost a micro fund, so we do our capital calls normally, of course. But what we are seeing with Series A, B funds, etc., they are more reluctant. And I've talked to funds in the US, and they're like, yeah, we haven't written a check in half a year. And of course, they can conduct their normal capital calls as usual business, but they want to raise next funds with their LPs, so of course, they want to give them some time, wait maybe for the IPO window to open again. That's a little bit our take.
And Nico, how has it changed for High Ventures?
Of course, the macroeconomic environment affects our portfolio companies. So we are doing the active acquisition part, but we also want to support our portfolio companies in these days. But it's kind of like we also need everything from the team to do everything, to change your mind, to find new revenue channels, or so they have to do everything what they can, but we also think about giving them an extra, or we can ask them how that we can support them in this situation. Most of our companies are not really affected, maybe the utility prices or this part of the crisis, because they are not big factories or manufacturing lands. But of course they are at least affected by that their customers are change their risk appetite, and even the budgets are limited. So maybe they are not investing in now in digital innovation, maybe they are focusing to save their companies. So then the startup has some hard times now. We also see that in the investor part, the risk appetite has really changed. So they also think about doing other investments, which has lower risk and now higher returns than before. So that is one part. And some of them may have some investments in really risk countries like Ukraine, for example, or in Russia. So we see that the private money is much more difficult to get for a portfolio company as a next round in these days. And we find a new kind of standard product, which is maybe for the companies who are looking for Series A, but it seems like they need more time, they need more runway, or they need some money for accelerate their business in this part. So we made kind of like just a small amount. It's 1 million euro at most, and it's kind of with standard terms, or you can change the valuation in it. But it's a rapid investment. So we go deep down in the business, and we want to also evaluate them. But we kind of like to give a bridge for them to have more time and more money to reach the maturity to get a Series A investment. So that's what we found, how we can be more popular for the good startups to get some money and reach what they want.
Andreas, how has it changed for a fund that invests in later stages and does exits and IPOs?
I think there were some changes, but I think first and foremost what has changed is the sentiment, honestly. So I think we are still living in a world where growth is fueled by innovation, there is a proliferation of new technologies, there is a change of the habits and the behavior of consumers. So I think there is still a lot of opportunity out there, and then a lot of opportunity and problems to be solved by tech startups. So I honestly, I don't think that much has changed. What has changed is the market sentiment. What has changed is that funds are now more focusing on supporting the portfolio companies, and I think that's no bad thing. As you already said, so they are really getting more efficient. They are really concentrating on putting your company in well order. Funds also to maybe put more money aside to help existing portfolio companies. And I think that just shifts the focus a bit from new investments to the portfolio. And that's why I think some of the funds have definitely slowed down in deploying capital. However, I mean, there is a stockpile of capital building up. I think there are 500 billion sitting on the sideline waiting to be invested, more than ever before, especially also in the United States. What we've seen here in Europe was that much money has been deployed by these international investors over recent years. We have also seen these mega rounds happening in Austria, with rounds being larger than 100 million, which was unprecedented till then. And I think what has also changed is that these funds are drying up at the moment. So for the later you get, the closer you are to IPO or pre-IPO phase, I think the more the startups are affected. But I think it's slowly trickling down also to the seed stage, because everyone is changing the perception. Everyone is becoming more cautious. What we've done actually is just to continue our path. We are not slowing down in an investment activity, because I think it's more opportunity out there than ever before at more attractive valuations. And till IPO or till exit, you usually still have 5 to 7 years to come. So that's why we are actually quite opportunistic nowadays as well. And we see a bit of a déjà vu, you know, when looking back to 2020. We had this flash recession, a very short period, but actually what happened afterwards was a bull run. I think that was maybe a bit overshooting. Now we see more mean reversions, or valuations actually not crashing or collapsing, but rather reverting to pre-COVID levels of so valuations are still high at 2018, 2019 levels. So we don't see a crash. We're just seeing a bit more return to normal market standards.
Okay, that's very interesting. I just wanted to say to the audience, if you have any questions, you know, put your hand up, and we will give you the microphone, and we'll ask you. You'll ask the question, but we can then. Like also, because it's only 7 minutes left, so if you have your question, ask it now. And then if you don't at the moment, we'll carry on with the discussion. And in the meantime, you can, okay, we have a question here.
Hi, so for Andres, I want to ask about the KPIs. You know, you put a plan and then you put KPIs and revenues, but then when you go to the actual work, there is nothing that moves like in the plan, like it moves up and down. And you know that the market change, especially in technology, it changes too much fast. So sometimes you can't even cope in the market, and you need to work in agile work. Like you have to change your product a lot of time during the roadmap. So how do you cater this risk? And by focusing on numbers instead of people, like Joshua said, yeah, Johan. Yeah.
No, be sure it's not only about numbers, yeah. And that, what I said before is about this organizational readiness, and it's more about the engine, yeah, ready to accelerate or also to change gear. So we are not believing in any way in the long-term hockey stick plannings, yeah, but rather rely on the actual traction that we see from the past quarters or months. What we've also seen is this readiness to change, yeah, and adapt, and I think that's that also what makes startups so special is that the pace of adjusting to changing market conditions. You know, one of our startups in Poland, they were in the telemedicine space, and when we initially invested back very early 2020, they had their plans, and we were in a long-term game. We thought that, because we thought that telemedicine will take still another 5 years that it really gets adopted, because it also requires some change of customer behavior. You know, I think 3 months later, we were quite shocked by the new problems they were facing, just getting more people onboarded. And I think just on a quarterly basis, the revenues tripled. So I think that needs also to be managed. And I think the more ready the organization is to cope with downturn and growth, the better, the more sustainable this business model is.
Yeah, thank you. So another question is that the stages, how do you say that this is an early stage startup, while, I mean, I can be 500 users on my platform and still say that's in my early stage, and maybe I'm more...
I think that's a good question to all of us. You know, I mean, usually you had this pre-seed, seeds, pre-series A, series A. I think that has also a bit changed. We rather look at the maturity of the business model. Are you on revenue? Can also be that a seed stage startup is on revenue or even cash flow positive some of the time. Yeah. I don't know how you evaluate that.
Sorry, can you repeat the question?
The early stage, how do you identify that this startup is an early stage or not?
How
do you define the stages?
Okay, so when a company looking for funds, sometimes it happens there that they look for a 2 million euro, but I think if you are on the right stage, the amount of money you ask for, maybe it's parallel with it. So we cannot say for the company which is looking for 2 million euros that it's in growth phase. First, we have to find what stage in it and how much money we can risk in that stage. But as we said, it really differs depending on the sector. If we look for a company, we try to find the valuation or evaluate that. It's really different what we expecting or return from. So whether this company is capable to have a big market, so it will be bought for their market, and it's on the way on that, and which stage in this company. But for another company, maybe it has to be a sustainable, growing business, and the buyer will buy it for what they reached in EBITDA or margins, etc. But maybe there's another company, another market where they need 100,000 users, and that's the exit value in it. So we would like to see what is the potential in the company and in which stage on the way of that potential the company is, if we think that the team is capable to reach the next steps. So maybe that is the approach we decide in which stage the company is in.
Thank you very much for the questions. Unfortunately, we are running out of time, and I don't think we'll have time for another question. So I just want to thank all, our panelists. I think we haven't talked for a long time, but there were a lot of insights, and I had some questions answered for myself as well, because I was interested. So yeah, thank you very much, Andreas, Johannes, and Eniko. Round of applause, please. And actually, I don't know what's coming up now. I haven't checked the agenda, but you can do this with a QR code on your badge. And also, Hannes is coming here, and we'll tell you what's coming up next.